Hello, everybody. We're back. It's a little after 1 o'clock Central Time. We're located in Chicago. Wednesday, February 7th. And I'm Tom Sosnoff. He's Dylan Radigan. This is Truth or Skepticism. Dylan from Places Unknown. How are you?
I'm very good. It's nice to see you. It's a February Wednesday afternoon. These are the days of school and work and productivity. The days are getting longer.
Did you survive
it's light
that?
Out after 5 o'clock.
Did you survive that, whatever that crazy storm was in California?
Yeah. So I had the good fortune of being on the red eye the night before it started.
Oh.
Wouldn't really take a red eye, but I did see the weather forecast and took the red eye the night before. And so in that case, I was able to watch it on television from New York with the rest of it. Although from talking to everyone out there, obviously parts of it were horrendous and it's just an insane amount of water.
Yeah.
But also the news most of the people of California are okay.
Good.
Yeah.
I was in California last weekend too, but Southern California, and I missed it by a day.
I consider it a lifestyle choice to avoid major natural disasters, just as a way of life personally.
Well,
similar.
I mean, generally speaking, though, if it's an act of God, they don't usually give you advance warning. That's why it's an act of God.
It's tough to anticipate. You gotta just kind of trust. You gotta trust in your instincts.
If you are allowed to anticipate, it is not a natural disaster. For whatever reason, it's like a market crash.
No, but it's like when there's a tsunami, like the birds and the deer and the squirrels all run uphill.
Sure.
Because they know ahead of time. That's how I feel. I'm like, it's time to go.
Yeah. I don't run uphill very well. So like when we're about to have a natural disaster, I'm not good at
rapid evasion.
No, it's not my strength.
Rapid catastrophic evasion.
No, not my strength.
I had the pleasure a few years ago of being in Southern California, in the peak of one of the fire seasons.
Oh God. Yeah, I remember that.
That is truly alarming. That you want to obviously we've seen so much of the catastrophic things, but that's really the scariest natural disaster out there.
Yeah.
Just the water is startling. The fire is shocking.
Yeah, well, water, you think you got a chance. Fire, you have no chance.
That's it. Yeah, the fire is like this. I call it Satan's tongue. I mean, it just comes over the hill and that's it. The water, you're like, you can climb uphill. But the mudslide, listen, the other thing is it's a national pastime for everybody who's not in California to regale themselves with the stories of the catastrophe of California as a matter of like water cooler discussion. The evening news, they're like,
I do.
Look at the earthquake, look at the fire, look at the mudslide. We love it.
Well, I do take some. I do feel kind of like living in the city in Chicago that, obviously people are going to go, well, you've got cold, you've got other things you've got to deal with, but, not having to deal with a lot of natural disasters, I kind of like that.
But that goes, I think, to that. So it brings up the fundamental question, which is, does growing up in New York or Boston or Chicago or wherever, Austin or any normal city, we'll call it, or growing up in a place like California, which are these ungrounded, uncentered, unstructured place, does the structure create the mindset, or does the mindset create the structure?
Interesting question.
Obviously, if I was to take you to California now, you'd be like, this makes no sense, right? All this natural disaster risk, you can't walk to get anything. On and on and on.
Yeah. Listen,
mindset.
I get it. Anyway, I don't want to spend too much time.
No, but it's not a waste of time. I have a purpose in my inquiry.
Give it to me.
I'm in the middle of a journalistic sidewinder here. So much as there's the mindset of the Chicago urban trader and his lifestyle, buildings and blocks and subways and diners and restaurants and things. And then there's the lifestyle of the sort of Santa Barbara hillside dweller, who might be of a similar social and educational class as the Chicago city dweller, but that person is more on mudslides and fires and floods.
Yeah.
Let's assume that it's the mindset that selects for the environment. So the person with the Chicago mindset moves to Chicago. You weren't born in Chicago. You chose Chicago. You're like, I like Chicago. I'm going to move here. I like these people. I like this way of life. I want to make a life here, right?
Yeah.
And people do the same thing. They move to California.
Yeah.
Do you think the same mindset principle is how much? I mean, obviously it is going to be true, but how much is the mindset principle that is demonstrated there true in the distinction between the active trader, who's always going to be an active trader, regardless of the returns? They're not an active trader because they're like, oh, I outperform the index and this is my thing. I'm an active trader because my personality is to do this thing and behave in this way and live in this world of information. And sometimes I do better than the market and sometimes I do worse, but it's a way of life.
Sure.
Living in Chicago.
Sure.
Right. And then the passive investor that says, listen, maybe I could make more if I learned more and spent more time and paid more attention and learned about the, time value and all the things, or I could just stay passive and whatever the S&P does, it'll do.
Yeah.
That's also a mindset.
Yeah. Sure.
And I guess my question is, how much are those two mindsets changeable? And how much of those two mindsets predetermined almost by the same way as a person who would live in Chicago versus Southern California?
It is extremely difficult to, change that mindset. And most of us, there are certain conditions, pandemic in 2020, bear market in 2008, bear market in 2000 to 2002. There are different situations when there's definitely a transition, a natural transition, or there's a transformational moment like the pandemic, where there's a transition from one side to the other side. Just like there's things that happen.
But I guess my question is, can't both mindsets exist in the same human?
No.
Really?
No.
So you have to pick a side. Well, I can't be 80% passive, 20% active?
Sure. You can be somebody that goes to Vegas once or twice a year to gamble and have fun doing it. Yes. And you can be somebody that has a hunch in the market, so you bet a bunch, and you might be right, you might be wrong, who knows? But you can do that, no question about it. I've done that for myself with digital assets, let's just say Bitcoin, buying some Bitcoin or, whatever, just passively buying something, hoping it goes higher. But the reality is to be kind of a participant, the answer is no. People that gamble, and I'm going to use a bunch of different fields here. People that gamble generally don't gamble because they're gambling to make a living that exceeds some risk-free or passive rate. They're gambling because they love it. And
the pleasure.
It is. And people that, let's just say, that love to cook, they do it, because
not because they're hungry, not because they're
exactly, hungry. Not because they're hungry. And some people that play certain sports do it not because they can make money on it or gamble on it, just because they love what they're doing. People that actively participate in the markets love the challenge. And so when people write to me and they say, what's a reasonable return that I can expect? And our response is always, well, we don't think of the markets that way. It's because we don't. And it's because people that trade don't think of things like in terms of, the simple answer that I give is, hey, you got to think of it in terms of a multiple of risk-free rates. But the reality is people that do this actively don't think of it as a multiple of risk-free rates because it's what they do. And that's it. It's just what we do.
What I'm asking is, you're saying a passive mindset and an active mindset can't exist at the same time in the same person. Is that correct?
I'm saying that for either you have the gene or you don't. And so
that's what I'm getting at.
Yes.
Which goes to only some people can live in Chicago and some people can't.
That's right.
Some people can live on the hillside in California.
That's
some
right.
people can live in downtown Bangkok.
Yeah, I cannot live on a hillside in Santa Barbara.
Right.
Even though I've never been to Santa Barbara.
Or metaphorically, any hillside,
Yes.
any California.
Yes,
Sure.
I cannot live on the hillside.
You need to get a cup of coffee. You want to go around the corner. You want to see Johnny and Kimmy and Sally and Susan and whoever's around.
Yes, I'm not good on a farm somewhere in
walking up the hill. Well, I'm worried about a natural disaster and a mountain lion. No, thank you.
Exactly. So, and no, I'm not capable. I'm not capable of flipping that switch.
You got to go defend us. So then let's take that person instead of, because last time we had this.
I'm not capable of being a passive investor. To get back to the beginning of your, I am not.
My point.
I am not a capable person.
So out of the 100 custodians of all the money in the world,
yes,
from the sort of every mom and pop at every RIA up to BlackRock and everything in between,
yes,
and AIG and whatever you want,
yes.
What percentage of the mindset naturally do you think is an active, engaged mindset? 20%, 50%, 80%?
Who are you talking about? Whose mindset?
Of all the investors, all the existing investor base, not the money, but the people.
98.2.
98.2 is passive.
98
mindset.
Is passive.
Mindset. I'm talking about the mindset, not the allocation.
98% have the mindset for passive, 2% have the mindset for active. But of the 98%, there's probably 20 or 25% of that 98% that
could be turned.
That have the gene, right.
So then so 20% of 98% is basically 19 percentage points, let's say.
20, so altogether 20, yeah.
You can go from 2%
to 20%
right now to 20% mind share.
Yep, exactly. That's who we've been trying to speak to for years. That's the growth
of the active trading industry.
That's
now,
right.
The greatest enemy of the active trading industry.
That's right.
The performance of the index. And in the Financial Times, as there is a recurring basis, especially when the passive plays, and there's a headline about a reduction of funds in actively managed mutual funds or whatever it was.
It's a classic of course, anytime.
You've seen it 1,000 times.
But anytime,
how do you compete with a passive market
you can't compete with a passive marketplace in a bull market.
For the mind share.
It's a bull market phenomenon. It's just a bull market phenomenon. You can't compete in a bull market phenomenon.
And so what you can do is activate the existing 2%, and then be prepared to scoop up another 1 to 5%.
Yeah, as soon as you get a change. Yeah, as soon as you get a change in the environment. If we went into a 5-year bear market, that number would go from 2% to 14%. Mm-hmm. Okay, it's just the way it is. It's just that we're, as long as people see their statements and they're making money, they don't, why do you want to change anything? But as soon as you get scared, and you have less money than you had before, then all of a sudden you're going to look for an alternative.
You're open to a different mindset.
Well, 20% of those people are open.
Yeah. Which means 20% of the people would leave Chicago and move to a hillside in California.
Which is exactly what happens. Eventually you get this, you get people that leave big cities and they go to places,
Nashville,
whatever. Florida, Texas, Arizona, whatever. But then you get also a whole new breed that comes in because they want the culture, they want the food, they want the jobs, they want the activity, they want the action. You ship out the old, you bring in the new, it keeps the system going.
And that's the future of active trading. And the only thing that exists for active trading is basically ease of access and efficiency of process. And so that basically communication is easier shared and access is easier shared, so that as people naturally experiment with the mindset, you get more traction, basically.
I mean, you could think of the future of active trading like you can think of the future of the big cities all around the world. And I'm one of these people that believe that the big cities all around the world, in every country and in every part of every country, essentially dominate the landscape. They create the culture. They bring in the most revenue. They create essentially all the liquidity in the marketplace.
All the tax revenue for the provinces.
All the tax revenue, everything. And essentially, the growth of our cities in our country and other countries is really the key, to economic success in these countries. And people that think differently, I'm sorry, you're wrong. It doesn't work that way.
But is that the active trader?
That's the active trader
metaphor?
Yeah, that's the active trader. That's the metaphor.
because there's just more actions per day from a city dweller, metaphorically, than there are from a country dweller, who would take fewer actions per day.
Yeah.
All right, I've said my piece. So I've got my answer. You got me to my 20%. You answered my exact question, so I'm quite
and I didn't read the article in the Financial
Times. But you've
Times.
seen enough. You've seen them enough.
I can basically write it in my sleep. But yes, I did not read the one you're referring to. To be fair,
for those playing along at home.
Yeah.
And speaking of playing along at home, we had a substantial moral issue recently with Elon Musk's compensation package. From his home at Tesla. Regardless of the shareholder approval, you were with the Delaware judge. Unfathomable was a legal term that came into play there.
I used the term reasonableness. The judge used the term unfathomable.
Right. So either way, we've created some legal basis. Both the words reasonableness and the words unfathomable, which implies a legal standing for the word fathomable.
Okay.
Agreed?
Yeah.
Okay. So I believe it is unreasonable and unfathomable for an executive to lead what amounts to a fraudulent capital raise, in my opinion, with SoftBank at WeWork for $47 billion valuation, and enriched himself and his cohorts, unfathomably, to use a recent word of the Delaware justice, only to then be thrown out in horrifying scandal and malfeasance, and then to return, even with new financial sponsors, as he's being discussed to do, into a bankruptcy court, may be legal much as Elon Musk's shareholder agreement is legal, but it is unreasonable and unfathomable on an ethical basis, on a moral basis, insofar as it sends the message of corruption in the relationship between money, management, and the judicial system.
And so are you looking for me to say that I agree with you?
Or that you disagree?
Okay, I didn't know if you were done. I think there is a lot of history in this country of very notable founders that have either been kicked out or see, I don't like the direction of suggesting that they fraudulently raised money at WeWork, because I think fraudulently raised money would be a really good way to describe Bernie Madoff, or to describe Sam Bankman-Fried, at FTX, or Elizabeth Theranos, right? Or Elizabeth Holmes at Theranos. I think that's a really good way to describe those three people. But I think that when you're talking about Adam Neumann, I don't think that he put a gun to SoftBank's head. I mean, they basically ran the board. They were there step for step with him, and they decided to put money in. If anybody was doing something that was a little bit maybe unethical, no, I'm not talking about the way he spent money or things like that, but I'm talking about as far as the capital raise and things like that, I would blame it more on SoftBank than I would on Adam Neumann, just because I thought that they tried to basically, put a print up to attract money based on their own success. And I think they were a lot of the problem, not Adam Neumann. I think SoftBank.
I'm just curious, why do you think that?
Because a lot of times when you have an investment and you don't know how to mark that investment because it's not liquid, because it's still private, you don't know how to mark that investment. So what you do is you say, well, in 2016 we raised money at 20 billion. But in 2018, we raised money at 37 billion, and in 2019, we raised money at 47 billion. That means wherever money gets raised at, that is the value of this company, which is the whole efficient market theory. That's fair. I'm fine with it. But a lot of times, company will raise, let's just say as an example, they'll raise $10 billion at $20 billion valuation, and then they'll raise 500 million at 47 billion. It's just a print, so that's the last number that comes up. So I don't like that. I thought they just painted the tape, which is essentially what that is. But I think when you go back and you think about, founders that left and came back. And because I think that's an important. I don't think this is just an Adam Newman thing. 'Cause I could care less about Adam Newman. I mean, believe me, I'm not trying to sit here and defend him. But Apple threw out Steve Jobs. I mean, I think that's fair. I think that Jack Dorsey got tossed. Michael Dell got tossed. I mean, the latest person that's probably all over TikTok and all over social media is Dave Portnoy. Selling Barstool for $400 or $500 million with a cap on it to Penn, and then buying it back for 1 penny. And now taking it over and now cutting a deal back with DraftKings. So, I think that did anybody have a problem with Portnoy buying back Barstool? No. I mean, because I don't think investors lost money unless you were invested in Penn. You definitely lost money. But like I bought WeWork after Adam Newman was gone. And because I figured at that point, maybe they made a low. And, I don't know what my actual price was. I'm going to guess around $10, maybe it was $6. I have no idea. Now it's like 20 cents. And I still have it. It's wallpaper. I got it. But, I mean, personally, yeah, I'm glad. I hope Adam Newman buys it back because it's got a chance then. It's got no chance now. It's a pink sheet stock in bankruptcy. I mean, listen. We sold. It happened to us. We didn't raise any outside capital or anything like that, but we sold a company for almost, let's just say, a couple $100 million and bought it back for less than 10 cents on the dollar.
No, I understand that valuation.
That's just trading.
The question is more the role of a CEO in the.
I understand. I mean, listen,
it's not the high or low exits. I'm looking at it more through the lens of.
No, I know you are, and I should have been more clear about my Adam Newman take. Like, there is something really interesting to me about a guy that can create a valuation of $47 billion and everybody knew exactly what they were doing. And, I don't compare this to FTX or anything like that. I think that a lot of the blame, again, has to go on SoftBank, has to go on a lot of these private equity firms, and has to go on the fact that Adam Newman had, an amazing vision, but he was an idiot. And he ran the company like an idiot. And but maybe he never would have gotten anywhere close if he ran the company in a smart way. But whatever the case is, I'm not so sure that I have a problem with him. I mean, if people are willing to go and bet on him again, I'm not so sure I have a problem with that.
Well, yeah, because aside from my unfathomable and unreasonable moral position relative to the double dip, I do agree with you that at the very least, if Adam Newman's in the room, somebody has a history. Like, if anybody can do anything with that set of assets in terms of activating a strategy and a sequence of budgets and sort of ideas and visions, he's got to be the only guy.
Yeah, like really? I'm going to give you a baseball example. So, you're an all-star pitcher, and you're making a crap load of money, and all of a sudden, you throw your arm out, and you need Tommy John surgery, so you're basically sidelined, and you kind of weren't totally upfront with the team because about when you signed a giant contract, something like that.
Vulnerability,
right? So the team goes, well, I'm going to go. We're going to replace you in the rotation with this guy Sosnoff out there. He doesn't really throw as hard as you. You throw 100 miles an hour. He throws 40, but at least he's honest. At least he's going to give us everything he got. And you're like, no, I'll take my chances with the guy that throws 100 when he comes back from surgery, because at least he's got a chance to be an all-star pitcher again, and I have no chance. And I think that when you think about, WeWork's an 18-cent stock right now. And when you think about, WeWork, and if you're an investor at this point and you're sitting on a bunch of wallpaper, you're like, hell, bring the guy back. He's the only guy that's got a chance to get it back to some valuation. Some random new person doesn't, that's for sure. Now you're thinking about that, aren't you?
Well, no. I'm thinking. No, because I'm thinking. I know. I'm thinking about another business that I know about where a group went in with the prior management into a bankruptcy court. I mean, I guess at the end of the day, every situation is a unique situation.
Yeah, yeah.
I do find it interesting to be, I would say, somewhat morally permissive with Adam Newman, and more morally strict with Elon Musk.
Okay.
And relative to it, I would just say that's you're into a gray area in terms of both my critical opinion of Adam Newman's return or your critical opinion of Elon Musk's pay package, when both, by all appearances, are somewhat within the bounds of apparent legal process and contract.
I mean, would you have a problem if Jack Dorsey went to Elon Musk and said, "I'll take you out of Twitter for 10 billion"? Like, would that be the greatest thing ever? And have Elon say, "I'd rather burn it to the ground and chop my toes off rather than give it back to you"?
I'll take it to zero.
Of course, but I guess my whole point is that, I don't. There's not that much difference.
And you're just saying that there's a story archetype. There's a story that exists both for the exile of a leader and for the return of a leader with a different army, so to speak, under a different circumstances. Whether it's Adam Newman.
I also think there's there's some kind of, if a guy like Adam Newman wants to come back to WeWork, then there's an emotional attachment to. All founders have this emotional attachment. I mean, as much as, like we say, hey, you know what, I've moved on, because they have moved on, and I've been in that same situation, there's still this emotional attachment, like to companies that you've built. Like, I watch an ad for Schwab on Thinkorswim, and I'm like, oh, that's cool. Like, and normally with a competitor, I'd be like, I hate that company. But, I look at it, I'm like, yeah, that's cool. Not that we're ever buying it back, but I'm just saying it's just like, I'm like, okay, that's cool. There is an emotional attachment.
And Adam obviously has that with this entity. I mean, I just don't know. I don't know. I just think that you kind of get, you have to pick whether you want to. When you select allowing a judge to massage the law, I guess the judicial system becomes very interesting, both with the Musk compensation and the bankruptcy court, because both are subject or sort of vulnerable to moral posturing from the bench that is at least in potential conflict with the existing contract law.
Okay. I'm not,
I'm not worried about it.
No, I don't disagree. I'm not worried about it. Yeah.
In other words, you say a court exists for a judge to offer a moral position from society to some degree.
Courts exist
more than an interpretation of a contract.
In the case of Elon Musk, the court exists to protect the shareholders, and it's a public company, and the shareholder, even though they own basically nothing, the shareholder has a right to challenge, there's plenty of incompetent boards in this country and all over the world. And the shareholder has a right to challenge the competency of the board and the judgment of the board. They absolutely have that right. And that's what the legal system's in place for. And that judge made a decision based on what he felt was the shareholder's case versus the board's decision. And how's that any worse than any, how's that? That's exactly what the courts are there for.
And in the same case, the bankruptcy court is there to get the best possible leadership team and probability of success for WeWork.
Of course.
That includes Adam Newman.
I do think you draw the line at fraud. So, for example, if Sam Bankman-Fried said, I want to come back and turn this thing around, I have a problem with that, because I do draw the line at fraud and at criminal. There's a line in the sand at criminality. So if Elizabeth Holmes wanted to come back, that's a no. And if Sam Bankman-Fried wants to come back, that's a no. Adam Newman, I don't think that's. I mean, I'm not sure that's a no. I don't think that's a no.
At this point, it's just a big dream and a big salesman with a bad outcome. And you could, I mean, listen, I'm not going to get into it, but the pandemic also was not a friend of WeWork, I'm imagining.
Yeah, but I mean, to be fair, like I am a shareholder of WeWork. I'm still long stock. It's not, at this point, I think it's 20 cents or 18 cents. I'm not selling it ever. So if you ask me as a shareholder, which I'm not a very big shareholder, but I have, I lost some money in there last year or the last couple of years, not last year, but last couple of years. And I don't think I've traded the stock in 2 or 3 years, but I was still long stock. And so as a shareholder, if I was sent something to vote on, I'm like, sure, bring them back. What do I care? I got worthless stock right now.
I guess the only question would be whether because Adam is still at the very least associated with a spectacular failure and a famously sort of self-promoting sort of lifestyle, which is not unusual for those people. But at the end of the day, does Newman bring back memories of that time of sort of like, does he alienate more potential active investors, active participants to vow that the game is rigged, basically, that Adam Newman made it on the top, he makes it on the bottom. Like, it's an inside game. If you're one of the boys, you're going to get paid. And if you're not, if you're a little guy, you're.
Well, I don't know exactly how that works that way, because I know plenty of private equity firms, and it's not their money. So, and they, but it is their lifeblood, and nobody's writing a check to Adam Newman because they like the guy. It doesn't work that way.
No, I get that. I'm saying, but does elevate? I can see why the money would back him. It seems rational almost. I'm saying, does that decision alienate a different group of investors, which is the little guy who already looks at Wall Street as a potentially rigged game, or sort of, it's like a game that's not for the little guy?
Well,
and does the Adam Newman return only validate that cynicism?
I'd be sure it does. It does validate that cynicism until, unless he's successful, that he can win it back. He can win back his fan base if he's successful, and that's probably part of the motivation, because he's out. He made a clean break. Why does he want to drag himself back in? Because of ego and because of emotional attachment. What's in it for him?
The redemption, the resurrection.
Exactly.
The
story. His ego.
The glory of the resurrection.
He's already got more money than he needs for the rest of his life. That's not it. It's just this is a chance at history.
Can I switch gears while I have your time and a few minutes left here? Going to some
yeah. Even though I love that story, but yeah, go ahead.
With Chris and listen, we'll see. I love your Jack Dorsey bid for Elon. I like when you reduce it to the personalization, and Adam Newman's restless, can't sleep because he's trying to get his handle back on the switch at WeWork. NVIDIA, AI, chip, madness, moments of pause. I know you're an AI skeptic, at least on valuation. I think most of us
I'm not an AI skeptic or chip skeptic, but based on valuation, I think we're in a level of we're in la la land.
And then there was Vecchio brought my attention to this story, but it had to do with a report of NVIDIA investing in companies that were becoming its customer. Yeah, but that's
old news. I told the story on air, Dylan, that when we started Thinkorswim,
meaning it's irrelevant.
Sun Microsystems lent us all the money. At the time, it was about $400,000. Sun Microsystems lent us $400,000 after giving us a 50% discount. So there was like $800,000 total. And I think they gave us a 50% discount. So it was total of, we had to put up $400,000. They lent us the $400,000. So you could buy $800,000 worth of servers for zero. Okay, and we owed them the $400,000, so 50% off. Plus, they lent us the money so we could start our business, and they had no issue with that. And we're like, and they marked it down as an $800,000 or a $400,000 sale. Who knows? But I guess my point is that was 1999. So, and their stock was 120 at the time. But soon on its way to zero. But I mean, that stuff has happened throughout time. Oracle did it to build up, they lent you the money to buy their database, and basically, Cisco lent us the money for their phone systems. I mean, that's the way these companies operate. Here, you buy this, and it's the same thing as a mattress company. Buy the mattress now, and you can have 5 years to pay at zero interest rates. Well, buy these servers, or
and all you really have to do is sign this contract, this deferred fee contract, effectively.
But the company signed it. There was no personal guarantees or anything, So it's no different, I'm telling you, than buying a mattress or new windows for your house. People don't realize it, but that is life in the big city.
But does it provide an opportunity? Does it at least provide? Does it alter your opinion, or do you have a positive interpretation of the momentary pause, if nothing else, in a little blowback after the insanity of the recent valuations?
Well, there is no blowback yet. I mean, things are today, all these markets, NVIDIA, Microsoft, Meta, everything, AMD, they're all on their highs. So as the NASDAQ makes a new high, the S&Ps are, making a new high. Everything but the Russells at, essentially at all-time highs. So there's been no blowback. I think that, am I bearish on a chip? Of course not. Am I bearish on price right now? Just because of, I think there's a time when gravity will destroy greed, and you will pay for this. And I don't know if that's tomorrow or a month from now or 3 months from now, but in very short order, there will be something that happens that changes the dynamics of the pricing dynamics. We're just, this is that going back to that irrational exuberance.
Yeah, well, it also reminds me of a couple of years ago, maybe during the pandemic, 2021 or something. There was a moment where Apple was going crazy a few years ago, just on and Tesla. We've seen it, and so I mean, this is sort of I guess are you trading around it? I mean, I guess how do you get it? Because certainly in talking to Ilya and Vecchia, and I'm sure you are, I should say, but talking to Ilya and Chris, you can have this opinion all day, but timing is almost impossible to tell, especially when you've got a wild animal.
So that is the hardest part of this. And that is the gambler part in all of us, because there is no such thing as, there is no way to time this. There is no way to know. Nobody knows. And anybody that thinks when this thing turns that there is some kind of crazy, that all the pros knew and they all got short, that's total horseshit. I'm short NVIDIA. It's my biggest position right now. Pure short NVIDIA. I mean, I did it with selling mostly defined risk positions, because you can't be undefined risk in NVIDIA. It's too damn hard, too damn expensive. I think it'll blow its brains out. I don't know. It'll be some news event. It'll announce that they're doing something unbelievable, and it will instead of going up, it'll go down. They'll announce a split or something. Instead of going up, it'll go down. Well, who knows what it'll be? But we're probably close, but I don't know how close. Could be tomorrow. It could be a month from now. It's expensive. It's an expensive opinion to have.
No, it's so attractive and so expensive, I suppose. I mean, how do you not get discouraged by your inability to really define the timing? Is it just because you cap your tops?
It's also because I've been doing this for so long, and I know it's impossible to time it. Like, I go back to, I was 4.5 months early in 2008, started to get long in the middle of November, and we didn't start going down until March, and it hurt. Like, that was painful. In 2020 during the pandemic, we were at 3,300. We went to 2,300 in the S&Ps. We're at 5,000 now, just to put it in context. But when we went from 3,300 to 3,000 and 2,900, I started to get long because I thought it's a gift on a 10% pullback. We pulled back 35%. That was painful. And those were just, S&Ps. this is a crazy move. And anyway, I feel like we're
You're saying your wisdom gives you confidence that you're right. Just hang in there.
yeah. No, I'm confident.
Hang in there.
I'm confident. You just have to stay small enough so that you can handle the pain. This is not like you can't essentially double down. Like you can't go to a roulette table and bet black and double down every hand, because after about whatever it is, 6 or 7 hands, you're out of money, and then on the 12th or 15th hand, you're basically taking down the casino. The other way, they own everything you own. But in trading, it's a little different. You can define your risk, and so you can basically hang in there, and you can roll forward so you can extend duration. It's a pain sometimes, and it feels like it's very counterproductive to all the other things you should be doing. But only a couple times every few years do you get to a situation where you're like, we all knew in 1999, that this rally was not sustainable, that it was a joke, and that these dot-com stocks were all going to crash. But it wasn't until March of 2000 that the market rolled over. But
a long time.
Yeah, from the summer of 99 till March of 2000 was 9 months. Where are we today in this AI craze? We're not on day one, but we're clearly not done yet.
Well, I would say we're maybe second inning.
But I think maybe we're 7th inning.
That, I guess.
Right. It just depends where you think. Like, I made my bed because I thought we're 7th inning. If you think we're 2nd inning, then you don't make your bed yet.
No, but because I think we're second. I would make a strong case for second inning in terms of deployment. In terms of valuation, I think valuation is detached. I think it's uncorrelated. Basically, that the entire basket correlates to some abstract future reality, which can go higher or lower. But and your point is the dream ultimately has to meet reality somewhere, somehow, and that it always happens at some point. You just got to be able to stay small enough to hang in there until it happens.
Yeah. Yeah. You can never put yourself, regardless of your ego, regardless of, your bankroll, regardless of anything else, you just can never put yourself, you can't put yourself in that position. You have to stay within your means. And it's okay to be wrong. But it's not okay to do something stupid and, put yourself in a situation you can never get out of. You can put yourself in a situation where you can be mad at yourself. You can't put yourself in a situation where you destroy what you have. That's the difference.
And that's all. That's where sizing is destined.
That's where sizing. That's where understanding. That the forces are a lot of times they're way bigger than you, and you have to just deal with it. Yeah.
All right.
Anyway,
well, I believe in talk, sir.
We are out of time, sir. It's 1:48. We went way long. That was a really interesting discussion today. He is Dylan Radigan. I'm Tom Sosnoff. This is Truth or Skepticism. Fun talk, Dylan. We will see you next Wednesday. Looking forward to it.
Likewise. Thank you.